Right, well, as they say, the ATO doesn't refund regret.
Historical gains remain protected and future growth becomes taxable.
This 3-year transitional window from 1 July 2027, take full advantage of that, what the exemptions are, what carve-outs there are, what opportunities you've got.
Every meaningful financial decision comes down to a considered move, the right structure, the right timing, the right tax advice and legal advice before you act, not after. Welcome to The Considered Move, the podcast from Andersen in Australia. Over this series, we're going to be working through the tax and advisory questions that matter most, whether you're running a business, looking after family wealth, or perhaps advising people who do. I'm Callen, Dendle, the National Tax Director at Andersen, and I'll be guiding the conversation. With me across the series is Callen, the Chief Executive of Andersen in Australia. Cameron brings the firm's view to each conversation and turns the technical changes into what it means in practice. Joining us today is Dermot Reiter, Senior Financial Advisor at APT Wealth Partners. He's spent more than a decade helping individuals and families with these exact kind of decisions: when to sell, when to hold, when to buy, and how that fits into their plans. Today, we're going to be talking about the capital gains tax changes that were announced in the budget and what you need to do to act. Dermot, the question we're hearing a lot from clients is a pretty simple one. What should I do next? Should I sell? Should I hold? Where do we go to? So that's going to drive the discussion today. But perhaps we'll start with a lay of the land, Cameron. Perhaps we can get into what the changes really were on budget night.
Sure. Thanks, Cal. And welcome, Dermot. The government's proposed replacing the existing 50% CGT discount with a cost-based indexation regime from the 1st of July 2027. So at the same time, a minimum 30% tax would also apply to capital gains. So essentially it's, rebasing a minimum floor in terms of a minimum capital gains tax. Future growth in pre-CGT assets would also be brought into the tax net, and that's also a fairly significant consideration, particularly for those affected individuals, partnerships, trusts, a lot of family wealth tied up in those old assets. So, it's broadly going to affect every asset class. So it is far-reaching. The only real carve-out is for new residential builds. So essentially, it's quite invasive in many respects. So, but whilst the headline focuses on tax, I think the biggest story is the practical impact on investment decisions, and really interested to hear your views on that, Dermot. Part of this conversation, succession planning, valuations, and ownership structures.
Absolutely. Well, thanks for having me, and great to be with you. And it's a really topical area, and I think in my career, I've never seen a budget that's really had so much interest from the public, and a lot of the articles and conjecture that we've seen since then has been really fascinating, and some clients are a little bit despondent as to some of the measures and their ability to get in front. And I think it's really important for us first up front to just take a deep breath and just act calmly, gather the information and make really high quality informed decisions. And I think that's why having good advisors around the table, like the likes of Andersen's and APT Wealth Partners, to be able to help guide people in making those decisions is really important. This is really where we earn our keep. And the classic case, I'm getting calls from lots of clients of, do I sell up? Do I move to Singapore? Do I do drastic things? I think it's really important in the first port of call is to actually understand what is the key role of each of the assets you've currently got in the portfolio. And a great mentor of mine said, financial planning is not that complex. It comes back to risk, return, cost, and tax. And I think if we just go back to those basic principles, risk and return are even more important than they have been historically. I think now, even more so now moving forward in the property market, because if you're not getting a tax deduction for negatively geared properties, we need to think outside the box a little bit more and adjust the strategy. It's not that the system's broken, that you can't get ahead. It's just that you need to be a little bit more thoughtful in how you make those choices. So I think where the tax strategy really complements the overarching financial advisory strategy is where the tax tail doesn't wag the dog. You're looking at risk and return. What do I expect to generate from this asset? And within the rules, where can I own it to optimize the after-tax outcome? So for me, it really comes back to owning really high-quality assets that have the ability to generate your required rate of return, both now and into retirement. And this is the work that we do in helping select those assets and then collaborating really closely with the likes of you guys in the accounting profession to get the best outcome for our clients.
The capital gains tax is where the tax calculation meets the investment decision in a way. Cameron, you look at what people might owe from a tax perspective, and Dermot, you look more at what should they actually be investing in.
Mm-hmm.
So where do you two see those two kind of meeting with the changes or pulling apart because of the changes?
Yeah, I think there's a few things on that. There's the tax outcome can obviously be optimized, but sometimes you can do that through too much complexity. So you need to understand that in the real world, you're dealing with humans and human behavior, and having multiple structures and trusts and companies and all the complexity and time that comes with that. You've got to work out whether that's going to be the right fit for every client. And I think the other thing with that is that you really need to understand what expected return do you expect to generate from each of those assets moving forward. So if there's an asset that regardless of the budget changes, you were going to sell anyway because it's just not really pulling its weight in terms of income or capital growth prospects, then regardless of the budget changes, you're probably going to want to sell that asset. The other big thing for me is if you sold the asset, what do you do with it? You need to have a really considered approach to, if I'm going to be ending up putting that money back into an asset with a similar risk and return attributes in a similar structure, what is the point in doing that? So the way I see it is some of the gains that people are sitting on, in a sense, that's kind of like an interest-free loan from the government that you don't have to pay that tax bill unless you absolutely have to. And so the question becomes, and this is where really the modelling and some of the tools that we've got on the financial planning side are really important, is helping people bring tangible focus into what are the trade-offs. If I sell now and I pay the tax bill and I put it into an alternative asset, what's my payoff period to get back that tax bill that I've got to then pay? So I think the motivation really comes back to what are my options and how does it fit within the broader strategy? And the other big thing that we're seeing at the moment is there's a lot of people with concentrated positions, particularly in property and direct shares, either through their employment arrangement or just because the tech sector has produced some pretty stellar returns. So again, if you've got a concentrated position in your portfolio, even though it might hurt on the tax side of things to liquidate that, it probably makes sense from a longer term financial strategy perspective. So I think risk and return have got to come before tax in that decision-making process.
Cameron?
Yeah, look, I'd agree with that. I think, I guess the real issue is not so much about the removal of 50% discount, the indexation consideration or the 30% minimum tax, but I guess how do you separate yesterday's gain from tomorrow's gain? And the practical questions we are sort of seeing from clients and non-clients as well in terms of discussions that we're having is that, what is actually grandfathered in all of this, how it's measured, will there be valuations required? I think that's a really important piece from 1st of July 27, what records are needed, particularly for historic assets, and importantly, what structures now remain appropriate. So they're sort of more holistically looking at these raft of changes. The other important thing to note as well that, we've only had really broad announcements. We haven't had any detailed legislation, and there's a whole lot of things to work through in terms of how it interplays with other rules. But I think importantly, it gets back to, whether it's the right investment, whether that still remains constant. So, we often say to clients, don't make an investment decision based on tax or necessarily the structure you're in, but really, speak to your financial professional like APT here that can give you that advice and, look at it more holistically. Don't let the tax tail wag the dog.
If someone was to come to you today and sort of pose the question, should I sell everything? What do you take a step back and look at? So when you sort of go, how do I answer that question for a client? What are the critical things that are going through your mind to give that answer?
Yeah, so I'd come back to the facts and I'd look at if you were to do that, what would be the implications from a tax perspective? accepting the fact that you've got the existing rules that are in place to 30 June 2027.
Moving to how it's impacting people, not everyone's affected equally from the changes. If someone's wondering how this touches them and what's a quick test to think and ponder for them, what should people be paying close attention to, Cameron?
Yeah, it's a good question. Look, I think for existing investors, they're probably going to look at what the current portfolio looks like, certainly their existing structures. I guess some of the points Dermot made there around, I guess, the external market conditions, whether it's a continue to hold, or is it potentially looking at a restructure or a, offloading of a particular asset. I think, look, to really ask that question, I think the valuation piece is going to be quite interesting. I'd be looking at how that potentially looks from the 1st of July 27. Certainly, any disposals up until that date will still fall within the existing rules. So, yeah, I think valuations is a really strong discussion point. I'd be thinking about, like, for example, looking at different asset classes, listed shares. That's pretty easy because you can get that information. It's readily available. Investment property, probably manageable in terms of valuations. Commercial property, potentially more complex if it's part of a larger development. Family businesses, I think that's potentially very complex as to what that is likely to look like and how that interplays with all of the other small business, potentially CGT concessions, and a number of other rules. I think farms, potentially very complex as well. Trust assets, also very complex. And pre-CGT assets, I think that's another very, very complex area as well. And you also have some inbuilt transitional rules that can apply with respect to ownership and also the percentage between pre and post CGT assets. So, look, I don't think pre-CGT assets are the whole story, but they're certainly one of the most significant practical aspects. I guess a key point I would like to make would be that historical gains remain protected and future growth becomes taxable as a key takeaway. So the questions that remain will be the valuation date, the evidentiary requirements, improvements, and succession implications, certainly for families and intergenerational wealth and the like.
Great. Dermot, from the wealth side, who do you see in your clients that are feeling it the most? Is it retirees? Is it long-term investors who have large unrealized gains? Is it people that are kind of at the beginning of their financial planning journey? Where do you sort of feel people are having the most tension with this?
Yeah, it's a good question. There's two key segments that I think that are really affected by this, and it's the small business owners in the sort of middle of their life, in sort of 30s and 40s, that are trying to build, and a lot of businesses, particularly in like the tech space or where your cost base is effectively zero, and a lot of their retirement strategy is tied up in their business. And despite my best efforts, a lot of them don't contribute to superannuation along the journey because they say that my business is my life and I've got to pour every dollar back into that and it's their heart and soul. But the idea behind that is that they get to the end of that journey and there's a sale event and then they can put it into super and take advantage of some of those small business CGT exemptions that you referred to before. But now the government's going to take a much larger percentage of that hard-earned effort. I think they're really affected. The other ones, and you probably come across the Robert Kiyosaki, rich dad, poor dad, build wealth through property and lever up that property exposure as much as possible. So a lot of wealthy or high income earning clients, they want to build wealth through that mechanism and that asset class. And so the ability to not generate, I guess, a tax deduction through the negative gearing process, they're really affected as well. But I think the other ones are the ones that are just in the middle of their life, in that sort of 30s to 40s range, that are just trying to get ahead and reduce they're often paying the top marginal tax rate, and they're just trying to reduce that either through a trust or another mechanism like negative gearing. And they're not going to enjoy the same benefits. But it was interesting in the Fin Review recently, there was a interesting illustration of the baby boomers sort of on the cruise ship, sort of waving towards people, and a lot of them are unaffected. A lot of my clients that are loaded up in super don't have a lot of money outside. They've escaped these changes unscathed.
They've got their large family home already
they're
paid
okay.
off. They're not.
So I think a lot of them are unaffected, which is great news for them. But we've got to get a bit more creative for our younger clients, I think.
I was just going to say, look, I think a lot of these changes are pushing more focus into superannuation, which seems to be largely unaffected, certainly based on the announcements to date. And yeah, I mean, the 1/3 discount is still there. So effectively paying 10%, obviously in relation to, super balances under $3 million. The new 296 rules don't come into play. Pension phase out assets and obviously an application of minimum tax. So I think there's certainly, there is still a safe haven, so to speak, for investment. So I would think, and this is probably a question for you, Dermot, are you seeing more inquiries of clients now pursuing or looking into self-managed superannuation?
Yeah, absolutely. Yeah, it's a good question. And that really is, I think, the key takeaway from the budget is that the superannuation environment is like the last bastion of real tax efficiency left, maybe outside the family home. The asset mix across your different structures is really important. So for quite some time, regardless of the budget changes, I've been loading up my clients' exposure to growth assets in super funds, which has worked really well for like equities, properties, alternative assets. And then for my fixed interests, my defensive exposures, and other cash and term deposits, I have them in the trust and company and non-super structures. So even though it's a little bit clunky because you're managing risk and return and growth and defensive across different entities, it works well from an overarching after-tax perspective because growth assets, as you mentioned, with a 1/3 discount. And the other aspect is you got, at the moment, $2 million that you can have per member in a tax-free environment up to age 60. So even with the recent Div 296 changes, where the additional 15% is imposed on balances above $3 million, I still reckon a lot of people are going to be better off keeping the money in there and just copying the additional tax. Because what's the alternative? You rip it out, you put it in, you're paying 30% at least. And that's the other thing is I think 30% is a little bit disingenuous because it's actually 32% when you look at the Medicare levy as well. So for me, it's just keep the money in super for as long as possible. And I'm even talking to clients now about just keeping money in the accumulation phase long-term for the high net worth clients. Because when you convert to a pension, obviously you're mandated to take that money out. You do get the first $2 million tax-free.
It's a really good point around the $3 million balance. I know, Cameron, you've had a few clients that have asked, do I need to really tightly manage that $3 million balance? And you've been looking at that for people lately and perhaps not as big a concern as people had when those changes were announced?
I don't think so. I think that your point you make as well, it is really 32% because you have the Medicare levy on top of that. Are you just ripping it out of super to put into another structure that's going to be impacted the same way? For deferral, look, what I sort of take away from a lot of these changes is that, look, you shouldn't necessarily sell before 1st of July 27. And, just through teasing out in this conversation, certainly the super strategy, for example, I think is now more relevant than ever because now, as you say, it's the last bastion of tax efficiency in many respects and concessional, certainly on capital gains tax at a 10% rate versus, say, a 32% with the Medicare levy. So I think that's certainly something that clients now will be really strongly considering.
I think just another point on that, we're seeing some of the conversations around succession brought forward as well. So I like to look at things holistically across the family group because for a lot of people, they work really hard, they've accumulated these assets and it's not really for them to consume. They want to set up the next generation. And it's best to do that actually progressively through time and empower your beneficiaries and your children with the money values, not just the dollars that come with it. And so topping up your kids' super is a good way of doing that progressively through time, gives them a tax deduction along the way. You can also, if you want to help them into the property market, there's some opportunities maybe now with the prices coming back a little bit where it might be a good time to sort of bring forward those discussions. So I think viewing wealth as a family strategy is more important than ever because there may well be some other tax laws and other legislation around how inheritance is taxed moving forward. I think that's certainly been on Labor's agenda for a little while, but we don't obviously know any details around that. But I think empowering the next generation and thinking about building wealth as a family is really important.
Just to pick up a theme from a little bit earlier, Dermot, if someone was to sell an asset purely for tax reasons, what does that potentially put at risk in terms of their overall plan? What broader lens they should be bringing to things? Are you able to just talk us through a little bit on how people might want to think with a bit broader perspective than, oh, well, it's just a tax question?
Yeah, that's right. Well, as they say, the ATO doesn't refund regret. So I think it's really important to understand that if you're making a decision just for tax purposes, it's likely not going to be the best decision in the context of your broader wealth and an accumulation of wealth perspective. So for mine, it really comes back to let's deal with the facts unemotionally. Let's understand the quality of the asset. And this is really where I think the research and the role of us as advisors in being able to get really high quality information around our clients, particularly for those that have got properties. Valuation, I think, is going to be really important as at 30 June, but also what research and what information do I have around what are the future prospects of that asset? Because if I'm just selling for tax reasons, but I'm selling a great quality asset, then I'm really harming the accumulation of wealth longer term. Regardless of the budget changes, if it makes sense to sell it because it fits within your broader strategy, because you want to diversify, because you've got an opportunity to put money into a more tax effective structure like super, if it fits within your succession plan because you want to start to transition wealth to the next generation, that's the ticks in favour of maybe selling. But you need to have a full set of information, and I wouldn't be jumping at shadows now between now and 30 June 27. The other big thing for me is this 3-year transitional window from 1 July 2027. Take full advantage of that. Let's crawl all over the details with your advisor around what the exemptions are, what carve-outs there are, what opportunities you've got. Don't do anything prior to understanding with full knowledge what the ramifications of that decision is going to be.
Very good advice. Cameron, what's the most common misconception that you're seeing at the moment from clients?
I think there's quite a few think this is the end of the world, and certainly the entrepreneurs now. We've had a few inquiries of those just wanting to effectively liquidate everything here and reestablish themselves overseas. So possibly a knee-jerk reaction, but I think some of them have very valid points given the amount of sweat equity risk they take on in development. They don't see necessarily this as a conducive environment. But if I was to say one thing, I wouldn't sort of move too quickly. I think take this opportunity now to review what your existing position is, take full advantage of the transitional window, certainly the ability to restructure where appropriate, and make those decisions in a very considered way by consulting with obviously your financial advisor. It's really important to get that advice, reviewing all of your assets, whether or not they're ready to be to either realised or maybe redeploying capital, those types of decisions. And I'd probably just want to understand, what is, develop some sort of balance sheet of unrealised gains, having regard to, likely valuations. But once again, we're having to take a sort of bit of a future view, another 12 months essentially until 1st of July 27. So we still have time, but that time will run out very quickly. So I'd be maximising that time or using it appropriately over the next 12 months to really assess, what is your best position and where do you need to adjust?
From the finance side, what are you hearing is the most common misconception?
I've had a couple of clients ring up in a state of disarray saying that there's going to be a 30% inheritance tax. So the testamentary trusts is a big change that haven't been established yet, but a lot of my clients have provision for that structure in their will, and the minimum 30% tax rate does alter the benefit of that structure from a tax planning perspective quite materially, because I've got a lot of clients with testamentary trusts that have 3 kids, and the classic case have been able to stream 20 odd grand to each of them, and that effectively is received tax-free by those beneficiaries, and that pays the school fees. So that gone are those days effectively. So, but a lot of people have the misconception that there's like a 30% on capital going into that structure, and it's not. It's 30% on the income that structure generates. So that's one of the big misconceptions. And the other one is that Anthony Albanese is going to be a 47% business partner in your venture. That's not strictly true. There are small business CGT exemptions that are, I think, quite generous, and maybe the caps need to be increased on those. And let's hope that the government has the presence of mind to be able to actually make some reform on that, to give some of those small business owners trying to get ahead a bit of a carve out. But no, that the end tax rate is a lot lower than 47% for the vast majority of small business owners. So that's the other big misconception. But the detail doesn't often filter through to the memes on social media.
TikTok's not always correct.
No.
I might give you both a chance at a final comment. If you would, any final words you wanted to share with the audience in terms of these changes and where to next, what they should be doing as their next move?
I think the next move is, as you mentioned, Cam, update the balance sheet and book in a time to see your advisor and your accountant. Get your advisors around the table and let's have a calm, measured conversation, deal with the facts, and then work out our options with the full set of information. But let's not jump at shadows or get too overly emotional about what has transpired in the budget.
Yeah, look, I would agree. I think certainly there are going to be classes of investors that are more impacted by this. You can, I guess, optimise your positions with a view, assuming that these rules will pass through both houses.
And that's where we'll leave it. Dermot, thank you very much for joining us.
Thanks for having me.
If today's conversation raised something close to home, the considered move is to talk it through before you act. Your Andersen advisor can help you work out what that means for your situation. A quick note, remember that everything we've discussed today is general in nature and not advice for your circumstances. If this was useful for you, please follow the considered move and pass it on to someone you think might enjoy it. You'll find the series at andersen.com and on LinkedIn, YouTube, and your other favourite streaming services. I'm Callen Dendle from Andersen, Australia. Thanks for listening.